Welcome to Market Monday from the investment team in the trust department at the First National Bank. We're going to kick things off with a preview of economic data coming in over the next couple of weeks, particularly the points that may move the markets. Talk a little bit about the market and some of the themes that are going on, but overall this should be a relatively brief session this time. Starting things off earlier today, we got durable goods orders, which came in down 4.5%, versus an expected decline of only 4% for the January period. Now, that could be taken in the context of an expected recession as an indicator that we're starting to enter those territories because consumers will tend to pull back on big ticket items as they're starting to tighten the wallet in that area first and before other expenses. So that's worth watching. It doesn't appear conclusive, though, as you look, certain other categories, when you take out transportation or air, actually grew. So, it hasn't gone through the whole economy yet in terms of the durables. Capital goods are still rising. In other words, really big ticket items that get capitalized on a company's balance sheet over time. So that's saying that corporate investment is still pretty strong. We have information about the manufacturing sector. Purchasing Managers Index and Consumer Confidence, both are confidence measures, giving us an idea of how consumers are going to feel about, going forward. ISM, the Manufacturing Index, is a forward-looking sentiment indicator. We'll get information on the labor market, more sentiment information, more information on the durable goods and the factory orders, which tells us about demand and how that's holding up. The most important information, though, is not going to be any of these things. It's going to be on the 14th when we get CPI released. And the market's expecting a month-over-month climb of 0.4% and a year-over-year climb of 5.9%. Both of these down from the prior period and the prior reading, and that's going to be February's reading of that. Any news that indicates that inflation is remaining stubborn is likely to be taken in a negative fashion, leading to higher rates overall in the interest rate market and leading to potentially lower equity prices because stubborn inflation will imply that the Federal Reserve has to act for longer and take rates higher. So this is the most key information that we're watching, along with the Producer Price Index, which, arguably that's just as important as well because for corporate earnings, producer prices are an important part of the profit equation. Profit equals your sales minus your expenses. And PPI and CPI can be considered together to determine what's happening with corporate margins, which will determine what's happening with corporate earnings, which will determine what's happening with markets. And therefore, those numbers are likely to move the markets. We'll end things on the 17th with our next 2-week look period. With the University of Michigan Sentiment Index, again, that's going to tell us how investors feel or how consumers feel. When we're looking at the markets, things have been choppy, up and down, for the reasonable past here. And not much has changed, although we recently found a bottom around 39.50 in the S&P. And right now, we're treading up higher. As I'm talking in this afternoon, we're looking at about, 4,000, let's call it. And that is a pretty strong position to be in, given all of the negative news we've received over the past few weeks regarding inflation. Want to home in on payrolls, because this is another one of these numbers where it's showing the economy being a little bit truculent in the Fed's attempt to cool it down. You see that as of the end of December, we were slowing down the pace with which we were adding jobs. And instead, that's actually come up in January. This 517,000 number was about 2.5 times what the expectation was. We're going to get a read on that again. And if we get another monster number here, chances are good that indicates that the Fed is not getting inflation under control. The labor market is still running very hot, and potentially higher rates are in order. So we'll be watching that as a key number as well, along with that CPI, which, as I said, it's coming down. It came down from its peak right around 9% a few months ago, or actually that's June of last year, to only 6.4, and that seems like a big move. But when we zoom out, you get a clearer idea of what this really looks like, and you can say, well, this 6.4% inflation is not really down from a historical standpoint. In fact, most of history where this has been measured has been below this point. So the notable periods in 1981, the early period, the late 70s, early 80s, the mid 70s, and then wartime periods are the only times that number's been exceeded. So inflation is still running much hotter than what the Fed wants it to, if it's sincere in its desire to keep rates at around 2% for inflation. So we think the Fed has further and longer to do in its rate hiking cycle than they've let on, and the market may not enjoy that information. With that said, the market's a discounting factor for 18 to 24 months out, and as we look, this is a pretty solid bottoming pattern where it appears that the market is trying to settle in anticipation of potentially recovering after whatever recession as we experience it is. So we'll end this the way we always do. Zooming out over the last 20-year period to take this chop out of consideration and realize that, hey, we're not going to make changes to long-term plans that are made in a sound manner to achieve your financial goals based on some short-term events. The crisis of 2008, where, literally the system almost broke. Here was 2020, where everything was closed down. Here is the recent period of chop, a bear market that we've experienced over 2022. And yet still, if you take over the period, the market's had an annualized rate of return of somewhere around 8.67%. That's not bad. We need to take this longer view. We need to remain calm and consistent in our approach. If you have questions, feel free to reach out and talk to us. We'd be happy to talk. Hope you found this video useful. Thank you. Have a great day.